Your general manager crashes into your office. He wants to know why the owners are angry. The hotel is not doing well. What is the bottom line of our hotel operation? He wants to know. Which key performance indicator would you talk about which will reassure him about the bottom line of the hotel? Are you struggling to know what indeed is a hotel bottom line? But understanding the business performance of a hotel is one of the most important skills required of a hotel manager. Let me ask you a question. Would you know where to look? Let's say your revenue for a month has gone up, but the profitability is down. Would you know which key performance indicator or set of KPIs to look at? This is a very common financial analysis requirement that hotel managers come across regularly. But most hotel managers are struggling to read and understand financial statements. You could say that the profitability of a hotel operation is the direct link to a hotel manager's success. But why are hotel managers then not financially literate? And financial literacy begins actually with your ability to read and understand financial statements. This includes, of course, the ability to know one KPI from another, and most importantly, what KPI to look at. For example, what KPI stands for hotel bottom line? Did you know? It is the most important KPI for hotel owners. No wonder they are angry. This key performance indicator virtually ensures that your overall decision making has been sound. This is a KPI that will also give your career promotion a great boost. And you will be respected by your boss for your business savvy. You would want that, right? Now you would ask a question, why me? What is my qualification to talk about this? Well, I spent 26 years in the hotel industry in senior finance and leadership roles. I have actually experienced tons of profitability exercises, but more importantly, I've personally trained senior hotel managers to identify not just this, but many other KPIs. And I will show you how you too can learn to identify these and other KPIs easily. That will be definitely the envy of your peers, don't you think? And we'll be using a very simple but a system that your peers and other managers may not know about. That will also avoid those embarrassing moments for you when you were not able to read and understand hotel financial statements. Net income is often used as a measure to calculate return on investment analysis. However, there is a better measure, and we will see shortly what that better measure is compared to net income. So what is return on investment analysis? Metaphorically speaking, you could say it's a question of what you put in and what you get out. And what you put in can be considered the investment in the return on investment analysis. And of course, what you get out is the return on that investment that you made. What you will learn in this analysis are three things. To begin with, you will understand what are the elements involved in that return on investment analysis. You'll know about two common methods that can be used to calculate return on investment analysis. And then we will use one particular method, a simpler method in this video to understand how return on investment analysis is actually carried out. Okay, so I talked about a measure. Well, the cash flow is the most common component used to calculate return on investment. And cash flow is considered from two perspectives: cash inflows and cash outflows. So getting back to our putting in and getting out in the return on investment analysis, you put in the investment and you get out the return. So cash outflows are the investment and cash inflows are the return. But note something very important in this. Cash outflows come first. You need to put in the investment first before you get the return, which are the cash inflows. And so they come after the cash outflows. We will see this from the perspective of time. I'll explain what that means shortly. So getting back to our original metaphor, what you put in is the investment and what you get out is the return. Well, there are two methods generally used for calculating return on investment: payback period method and net present value method. The payback period method is the easier of the two methods, and we will adopt that for this video. So what is the payback period method? Well, there are three elements to this payback period method. First, it looks at how long it takes in terms of time period for an investment to pay for itself. And how are the incoming returns treated or considered? And number three, how will you interpret the results from this payback period method? So we talked about the three elements. One is time required, and we'll look at something called cumulative returns, and that will equal cumulative costs. I'll explain all that visually with an example shortly. Let's take a table. Look at the row number 1 right on top. So you can see what is being highlighted is year 0 to year 5. And then the columns are your particulars. First, we begin with investment. Note something. The cash outflow that is being shown, that's the investment you're putting in. It often is called the project cost. And note that it is against year 0. What is the year 0? Year 0 in return on investment analysis is your current year or today. So as we said earlier, we need to put in the investment now before we expect returns later. Okay, let's move on. Next, we look at the return. The returns are cash inflows. And note something. Cash inflows do not happen in the year 0. As I said earlier, you need to put an investment in this year, today, year 0, before you can get out returns, which is from year 1 to year 5. And as you can see, we have a $300 return on each of the years, year 1 to year 5. The next row is an important row because it's the investment minus return, what you put in minus what you're getting out. So in this, we will see how the project cost or investment is compared to the return so that we can arrive at a return on investment analysis. And the final row is itself the cumulative net cash flow. Now, what is cumulative net cash flow? Cumulative net cash flow simply takes the year you are in and calculates how much you put in and how much you got out. So in this particular case, you can see that in the year 3 and 4, or between 3 and 4, the investment is getting paid back. That's because you're deducting $300 from year 1 to year 5 against the $950 investment you made. And in year 3, actually between year 3 and 4, as is being shown, you pay off the investment. How do we know that? Well, you notice that year 4, the number has changed, the cumulative net cash flow number has changed to a positive number, $250. How'd you get $250? It's $300 return in year 4 minus $50 still left out of the project cost. Finally, something to understand is that year 5 completely pays off the project cost or investment. So you could say return exceeds investment by $550. And important to understand how we got $550. Well, we took $950 as project cost and we got a return of $1,500 over 5 years. So $1,500 cash inflow return minus $950 cash outflow investment is that $550 highlighted in white. Okay, so that's payback period. Let's take a quick look at net present value, which is a much more complicated method and a method that uses discounted cash flow, or what is known as time value of money. We will take a look at this method in a later video. Now, most important to understand that the payback period method is a simpler method, but it's not very scientific. While the net present value method is more complex, but more realistic. And as I said earlier, in a later video, we will examine the net present value method. Now, a couple of things you can link to your hotel operation with the return on investment analysis. Look at your own hotel operation. Consider renovation proposals, which can be considered a event for which you calculate return on investment. And also find out how payback period method is adopted to determine this return on investment. Finally, some questions you should ask in your operation. What renovation proposals have been made in the past or will be made in the future? And how is return on investment calculated for these? And then do you understand how the payback period method is adopted for this return on investment analysis for your own hotel? And what are three key takeaways on the return on investment? Well, the first thing is the formula itself. And as I said, that depends on what you put in versus what you get out. And the second is putting in are the cash outflows or the investment, and getting out are the cash inflows or the return. And finally, you say that return on investment is considered positive when return exceeds investment. As we saw earlier, the $550 cash inflows, which were higher than the project cost or investment of $950. Now, you want to learn net income. As I said earlier, often net income is used and cash flows are calculated from net income before you even calculate return on investment. Well, you can. Click on the video above for that.